look a little bit at plant assets, natural resources, and intangible assets. The first thing I want to look at is just this cost of assets. So cost of assets, all expenditures that are necessary to acquire the asset and make it ready for use. Some examples here would be the purchase price, the freight to get it to us, as well as the installation cost would all be part of the cost of an asset. For land, what we see with it, you are going to be looking at the purchase price, any closing cost, attorney's fees, commissions that you pay, anything that gets it also ready for use. So those ready for use items would be clearing the land, any filling, grading, any building removals if it already had a building there. Those are all items that would be part of the cost of the land. The next thing to look at is land improvements. So for land improvements, these are structural additions to land. They can include parking lots, fences, landscaping. Those are the types of items that you would see in the land improvements account. Now building, if under construction, so if you are constructing a building, the interest that you pay during the construction period is going to be considered part of that cost. So again, if you are actually constructing this building, any interest that you pay during construction, now remember this is just during construction, would be part of the cost. So you want to add that into it also. Other things to look at as far as this chapter goes are some of the expenditures during the useful life, because we have to break it up into what the ordinary repairs for it are versus what a capital expenditure might be. So when we look at this information, an ordinary repair is something there to maintain. Alright, so it's not improving, it's just maintaining what you already have. So maintain the operating efficiency, maintain the productive life of the unit. These would be part of a repair and maintenance cost. So it's repair and maintenance expenses. For capital expenditures, this would be if we actually increased the operating efficiency, productive capacity, if we increase the useful life, then that becomes part of the cost of the asset. And it would then have to be added in as part of the cost of the asset as a capital expenditure. So if we're just maintaining current status, that's an ordinary repair, it'd be repairs and maintenance. If we are increasing either the efficiency, the productive capacity, or useful life, that is going to be a capital expenditure, and it needs to be added to the asset's cost. Now, we've already looked a little bit at depreciation, but I do want to go into the factors that we have in computing depreciation. What we look at is we have cost, we will have the useful life, and useful life could be in years. Useful life could also be in hours. We're looking at those unit of production or unit of activity. And then the other thing that we have to know is the salvage value. Now, some books will call this residual value. Remember, that is what the value is going to be after we are finished using this product. So after its useful life, we'll be able to sell it for something. And so those are some of the things that you need to look at. The types of depreciation methods that we see in this particular book, we see straight line depreciation. That's going to be the same year after year. The second one is your double declining balance. And this is going to be, and you're going to take and double the straight line rate to get that. And the last one is units of production, or it's also called units of activity, and those mean the exact same thing. So we have created another video that actually goes through all of these items. The other thing that this chapter talks about is it talks about the book value. So with book value, this is going to be what it cost us minus the accumulated depreciation. That is what's going to give us our book value. Now, depreciation does not apply to land. Depreciation is going to apply to those other fixed assets, the plant, property, and equipment assets. It does not apply to land, however. And so that is, some of the things that we will see. We need to recognize depreciation on assets. Now, this is not an accumulation of cash so that we can replace it or anything else. All it is it's an allocation of the cost across its life. That is what depreciation is actually looking at. Another assumption that is in this particular chapter is that going concern assumption. Now, what this is saying is that the company will continue in operation for the foreseeable future. So if we don't use this going concern assumption, then we don't have a useful life, right? So depreciation does use that going concern assumption when we actually look at it. Some of the other things that we see, I just want to hit on, that revision of depreciation. Whenever we start out, I want you to remember that depreciation is simply an estimate, all right? So we don't really know what's going to happen. We don't know how long it's going to last us. We don't know how much it's going to be worth at the end of the time. The only thing we know for sure is the cost. Everything else we do is an estimate. So if we find that our estimate was wrong, then we will have to actually revise our depreciation. And when we revise depreciation, we revise it for the current year and then any future years or any future periods is what we would be revising it for. So that's what we look at when we look at the revision of depreciation. This chapter also talks about natural resources. Natural resources, some of the things that we see with this would be standing timber, underground deposits of oil, gas, and minerals. These are long-lived productive assets. They have two physical characteristics. One is they are physically extracted in operations, could be mining, cutting, or pumping. And two, they're replaceable only by an act of nature. So these are those things that are coming straight out of nature. And we don't depreciate our natural resources. We actually use something called depletion. And depletion is the allocation of cost of natural resources. It's done in a rational and systematic manner over the resource's useful life. And that is called depletion. They normally use units of activity method for depletion purposes. And so that is something that you can see out there. The other thing this chapter looks at is intangible assets. So this is really looking at that bottom part of the current balance sheet where we look at fixed assets and we look at our intangible assets. So intangible assets are rights, privileges, and competitive advantages that result from the ownership of a long-lived asset that do not possess physical substance. So some of these items would be government grants such as patents, copyrights, licenses, trademarks, your trade name. Those would be intangible assets. When we acquire another business and we pay more for that business than the assets are actually worth, that is called goodwill. and that is another item that is an intangible asset. And another one is when we look at franchises, like a McDonald's franchise, those are going to be things that you would see as an intangible asset as well. Intangible assets are amortized. Now, what amortization looks at, it is the process of allocating the cost of intangibles, and it's generally done, over 20 years or its useful life, whichever is shorter is what you would be using when we look at amortization. So those are just some of the things that, all right, and so that's pretty much all that we're dealing with this. There are some analysis of some different ratios and different things that you can look at. It also talks about if you traded an asset. That's not something we're going to get into in Accounting 101. That is something that you would get into in like an intermediate accounting class. But I did want you to just be familiar with some of these aspects that you will see as far as, our plant assets, natural resources, and our intangible assets. So with plant assets, we depreciate those. With our natural resources, we deplete and have a depletion expense, and intangible assets would have an amortization expense. And so those are some of the things that you will see in this particular chapter.